I don't think the fundamental support is, we talked about last week, and I wouldn't be surprised if, risk reward was skewed to the negative over the next few months. I don't know about June lows. I know you like to nail me down on that. That's tough to call, but I think risk reward's not great right now with estimates that are way too high.
So I want to get your reaction to something that Neel Kashkari said, Minneapolis Fed president, because I feel like this is telling on not only where we are, but where we might be going. He said the following in an interview today. I was actually happy to see how Chair Powell's speech was received. People now understand the seriousness of our commitment to getting inflation back down to 2%. Do you think people truly appreciate what's coming down the pike from the Fed, or no?
I don't know.
This says no.
Yeah, I don't know, because these guys were buying billions of dollars of mortgage-backed securities when the housing market was on fire in every MSA. So I don't know what the Fed's going to do. What I do know is CPI is going to stay high, because owner's equivalent rent is a third of CPI, and people can't afford to buy houses right now, so they're renting. And it's propping up rents. Talk to anybody you have on the show who rents out properties for a living. They're going to tell you we're taking 1% per month price increases. So the point of that, Scott, is it's going to be sticky. CPI is going to stay high. It's going to take a while to roll over.
Right.
And if the Fed's reacting to that CPI, yeah, they're going to stay hawkish longer than people think.
Well, I hear Kashkari, and I say, I hear in my ear, don't fight the Fed.
Yeah.
Right? Isn't that what he's saying?
He's saying,
don't fight the fact that we are serious in our commitment to getting inflation back down to 2%.
Now, the question is all timing, right? I mean, they were comfortable running way below 2% for a decade, and as long as they had us believing deflation wasn't the issue. So the question is, can they run above 2% for a few years as long as we believe inflation's rolling over? Then maybe markets can be okay. And I think people believed that a little bit in the rally, because they thought, CPI print wasn't as bad, earnings were a little bit better, maybe there's a fundamental reason to get a little more excited, and that was sort of the support for the narrative.
He took aim at that, too. He said, I certainly was not excited to see the stock market rallying after our last committee meeting, because I know how committed we are to getting inflation down.
Right.
And I somehow think the markets were misunderstanding that. And that goes back to where we started in the first place.
Yeah.
There's still a belief that the Fed's not going to be able to fully do what they say, because the economy is going to weaken too much, and they're going to have to pivot. Kashkari essentially says, don't believe the hype.
Yeah, I wouldn't fight what he's saying. I agree with that notion. I think they will remain hawkish, and I think the CPI's got a long way to go. Now, whether they can crush the economy to get 2% CPI next year is a different debate. I think they'll start seeing the edge come off of things that were supply-driven from COVID, semiconductors and stuff we've already seen, production catch-up, and if you look at NVIDIA and Micron and other guys who've reported. So some of that was COVID-induced supply side, but I think inflation can't get to 2% unless the economy is way, way slower. And as we've talked about, nominal GDP of 8 could come down a lot further. So I think that when I look at the stock market, obviously I focus on estimates and stocks and how to outperform. I see estimates as way too high, particularly for consumer areas where the numbers are still double-digit earnings growth next year, and that's what's got to come lower.
That's your guy Mike Wilson's point of view, right? He's still like, you could throw anything you want at me. It all comes down to earnings, and earnings estimates are still too high, and the numbers are wrong. Look, the numbers that the street is going on now are wrong.
They're way too high. I do think everyone knows that. I think the question is, can earnings actually grow next year or not? The sell-side numbers for next year are $243 in earnings for the S&P 500. I think the real number will be closer to $215. Right. So the question is, what do I pay for the 215? Do I believe 215 is the trough and it can grow from there? And so you can get fits and starts of market rallies, but the market looks like, to me, it's about 19 times actual earnings, not the 16.5, 17 times that are in the sell side numbers. So I think the numbers have to come lower. I'm not saying that the market's going to collapse. I think the stocks you want to avoid are the ones that have a big hockey stick in the estimates for next year and have above average multiples, because they could see that old double whammy of lower multiples and lower estimates.
What do you think is in the market now in terms of what it expects from the Fed and how slow it thinks the economy may get? Is a lot in or not enough?
I don't think,
at least in stock prices, forget earnings, but stock prices.
So I think the multiples assume that, and you can look at this in the bond market. I think the equity guys I talk to all day are a little bit different. I think they mostly think the Fed will act a few more times and then pause, maybe even have to sort of, totally put the foot on the brake by the second half of next year. I think that's what most equity investors think. I think they think earnings are too high, but there's things I can own, and so they think the risk rewards may be flattish for the market. That's a general case. I don't think most investors are saying, I'm positioned for a down 10 from here.